Royalties is an innovative financing solution for renewable energy and clean technology projects. We've got a simple mission to help accelerate the global energy transition while creating long-term value for investors. And I guess today I'll walk you through the growth opportunity in renewable energy, the financing gap we're solving, and how our business model works. And finally, why we believe we're uniquely positioned in this market to take advantage of this growth. And I think for anyone interested in following our progress, we trade publicly on the TSX Venture Exchange in Canada under the symbol RE, under the OTC in the United States under RROYF, and on the Frankfurt Exchange under Y2V. And I guess before I start, if I could leave you with two takeaways before we start this presentation. One is that the renewable energy market is really, really big, and it's growing very rapidly globally. And two, we're uniquely positioned to take advantage of this growth. We are publicly traded, so I have to give you this cautionary statement that basically says I'll be talking about stuff that's happened and not trying to forecast things that are going to happen. Our vision is pretty simple. We set out with two objectives, really. Create wealth for investors while generating a positive environmental impact. Easy to say, but something that we think we've done a pretty good job in achieving. And we've done this by building a diversified portfolio of renewable energy projects that generate stable or recurring long-term cash flows. These include solar projects, wind projects, battery energy storage systems, renewable natural gas, hydro, and energy efficiency infrastructure. The idea is to create a predictable recurring revenue stream as with the global transition to cleaner and more resilient energy systems continues. Importantly, our model is designed to scale. So we can invest new capital and recycle currently invested capital to drive revenue growth without incurring any additional operating costs. This operating leverage allows us to increase shareholder value as our top line growth falls directly to the bottom line. So that means every dollar of revenue we add from here on goes right to the bottom line. We were the first company to apply royalty financing to the renewable energy sector. And I guess for all of you out there, someone asks often, what is a royalty? Well, royalties have been around since the beginning of time. If you think of the first time someone came to a landowner and said, hey, I'll grow potatoes on your extra lot. And the landowner said, sure, you go ahead, grow the potatoes. I just want to take 5% of your production. And that's the idea of a royalty. It's been prevalent in the mining sector, the oil and gas sector, pharmaceuticals, music, you name it. But we were the first ones to take that proven business model and apply it to the renewable energy sector. We closed our first renewable energy royalty in March of 2016, and there wasn't really anybody else out there doing it. Historically, developers had to go to expensive venture capital, more expensive private equity, or slow and painful traditional bank debt. These options for them were highly dilutive or very restrictive. And what we did was take this proven model and that's already worked in many industries and apply it to the renewable energy sector. The idea for us is that in return for providing capital, we receive a long-term royalty stream as a percentage of project revenues over the life of a project. Our first mover position allowed us to build proprietary deal flow, develop strong industry relationships, and create a diversified portfolio. Other companies have entered the market since, so we now have competition, but that's great because that means more people are focused on what we're trying to do. We are a global energy solution, and I think it's important to distinguish that. Our first investment was in Eastern Europe. That's matured now, but we have many investments in North America, Mexico, Chile, Southern Asia, Puerto Rico. We were funded in 2016, listed on the TSX Venture Exchange in 2018, and began trading on the OTC in 2022. And last year, we expanded to the Frankfurt Exchange. Since inception, We've raised and deployed more than $80 million into a diversified portfolio across technologies and jurisdictions. And to date, we've been able to generate an unlevered internal rate of return on those investments exceeding 19%. And importantly, those returns have flowed to shareholders. Another important point is that 41% of our pipeline comes from repeat or existing clients. So we believe in platform growth. So we look at groups that we think have long-term growth and we want to grow alongside them. And we've demonstrated strong revenue growth, averaging about 60% annually over the last 5 years. In addition to financial performance, our investments generate meaningful environmental impact aligned with the UN's Sustainable Development Goals. So this impact profile also helps us attract lower cost, non-dilutive capital, including issuing our own green bonds to retail investors. So I guess the story is, why invest in RE Royalties? And really there's 3 reasons, and I'll give you the 3 primary reasons: is growth, capital protection, and our impact, or our ability to reduce carbon emissions. Most importantly is growth. We've grown significantly over the last 5 years, driven by increasing demand for renewable energy financing. And second is capital protection. Many of our investments are structured as secured loans, backed by project cash flows or physical assets. We also benefit from diversification. We look at different technologies, so different renewable energy generation platforms, different jurisdictions, and this is super important because electricity, although it's a commodity, it doesn't trade like a global commodity. It's very restrictive in terms of local jurisdictions. And we deal with a lot of different counterparties. We're also investing in different parts of the renewable energy life cycle. So if you think the traditional developer stakes out land, they begin to do permitting work, they then build, they operate, and we are sampling across that full value chain. So there's different returns, there's different risk profiles, and we're able to get a diversified look at that. And thirdly, our impact. So our portfolio currently offsets more than 400,000 tons of carbon emissions annually. So again, we think that's a pretty important piece for long-term health of the planet. So we can grow, we can save the planet, and we can save your capital and return it to you. So that, to us, is a pretty good investment thesis. I'm going to bore you with a few numbers now. The market is massive. So it's expanding rapidly across the globe, driven by technology cost drop. So in the last 10 years, we've seen an order of magnitude drop in the cost to build solar and wind energy, and battery storage is right behind. And we've also seen an order of magnitude increase in the efficiency of these generation technologies and in the battery technology space. So it's getting cheaper to build and it's getting more effective. In 2025 alone, the US added approximately 27 gigawatts of new utility scale solar generation, and about 6.3 gigawatts of small scale solar were installed. Rough order of magnitude, a gigawatt is about $1 billion worth of investment. So it's very big. In terms of wind energy, again, another 6.3 megawatts of new wind capacity added in the US, and battery storage is now the fastest growing segment in the industry, with installations rising nearly 40% year over year. So again, material growth. All of this creates enormous demand for financing solutions, particularly for small and mid-sized developers that are underserved by traditional capital providers. I'll give you a look at Canada as well. Between 2020 and 2025, Canada's storage capacity grew by approximately 56%, so almost 25 gigawatts. There are about 24 gigawatts. Again, that's about $24 billion of new renewable energy projects announced or under development across the country. And of that total, approximately 8 gigawatts are expected to connect by 2029. And by 2035, that's going to double. This creates a very large financing opportunity for companies like RE Royalties, and it's a significant opportunity for investors. On the dollar side, Canada will require massive capital injections to build renewables. Industry forecasts anticipate at least 59 gigawatts of new projects coming online by 2035. And actual investment requirements are going to be in the 14 to $30 billion. Governments alone can't finance this transition. Private capital needs to play a critical role, and we believe that you need to be innovative. And so innovative financing like we provide at RE Royalties is well positioned to participate in this growth. It goes without saying that today there's a heightened focus on energy security. Uh, Geopolitical instability has reinforced the importance of having the ability to generate your energy at home. As I said, electricity is a global commodity, but if you look at the United States, uh, there are at least 100 different electricity markets within the United States. So each state, states have two different markets, some only have one. Uh, and the only thing more difficult to build in North America right now than an oil and gas pipeline would be an electricity transmission line. So this means that connecting all of these different markets is very difficult. What this is driving is an increased focus on distributed generation. So rather than building a massive power plant and trying to wheel electrons for hundreds of kilometers, or thousands of kilometers in the case of the province I live in, we're building at source. So where are the consumers? Where does that electricity need to be built? Build the generation on site, close at hand. But it does mean that these are slightly smaller projects. And again, that plays to our strengths. So as I say, small and mid-sized developers are becoming increasingly important contributors, but they remain underserved by traditional financing institutions. The North American clean energy finance market was about $120 billion in 2025 and continues to grow steadily. At this time, US developers have safe harbored approximately 170 gigawatts of capacity. These are projects that have received investment tax credits and are ready to build. Distributed solar is continuing to expand rapidly, and community scale and mid-market projects are growing in importance. These smaller developers move faster and are more innovative, but they need more flexible capital solutions, and that's exactly where we operate. Policy tailwinds are kind of opening the door for these smaller developers because government policy is creating additional momentum for renewable energy investment. In Canada, there's a federal technology tax credit that provides a 30% tax incentive through 2034. In the US, the investment tax credits have got about another 6 months to run. Provinces in Canada are introducing new procurement models and community-based energy programs that favor smaller developers. And in the United States, policy deadlines are accelerating project out timelines and increasing the urgency around financing availability. These policies help level the playing field for the mid-market developers, so the ones who can't purely rely on scale, and are increasing the urgency around getting financing available for them. I'll say it again because it's a message that I can't say often enough. The energy demand is surging. Everybody is talking AI. In Canada, the top 100 companies are expected to require an additional 7.7 gigawatts of energy by 2040. AI infrastructure, data centers, electrification, manufacturing growth, and now security of local supply are driving demand that we're seeing globally. And then for electricity consumers, prices are only going up. Self-generating distributed generation allows partial disconnect from the grid. And if I were standing in this room, I would ask everybody who's present, how many of you still have a landline at home? And if you think about where we were 25 years ago, landlines were the only way to get your telecommunications. The same thing is going to happen in electricity. There are 5 billion people in the continent of Africa who are not connected to the grid. Distributed generation is the only solution for them. and it will be a continuing solution as North American and European consumers get tired of paying for excessive grid costs. But in order to get there, a clear financing gap exists. Despite strong market growth, traditional lenders typically favor larger companies, larger projects, and people with established balance sheets. I liken it to if you want to borrow $100 million, every bank is your friend. If you want to borrow $10 million, they say, hey, put that on your credit card. And so that is where we find the niche is that underserved market of small to mid-sized developers who struggle to access affordable non-dilutive capital. Our opportunity is really threefold. Three things going on. The revenue-based financing market is projected to more than triple by 2034. And at its basis, that's what we do, revenue-based financing. So we base our financing on the revenue that a project's going to deliver. Bridge lending, where people have to get to some kind of certainty is also one of the fastest growing segments within the clean energy finance. And procurement programs, corporate buyers, people like Amazon, people like Budweiser are wanting to buy renewable energy so that they can then tell their end customers that their products are green. And that's driving huge development. Some big numbers again. Most renewable infrastructure investments remain private market opportunities, typically reserved for pension funds, private equity funds, sovereign wealth funds, and family offices. The limits are that they often require high minimum commitments, long lockup periods, and significant concentration risk. And really, the public renewable energy market is tiny. In Canada, the TSX, it's less than 1% of the total stock exchange. So it makes it difficult for individual investors to gain any exposure to the renewable energy market and to energy transition. And what we do is we're helping solve this problem by providing public market investors with exposure to diversified portfolio of renewable energy investments through a single publicly traded company. We are, in essence, an ETF that covers multiple jurisdictions, multiple renewable energy technologies, multiple points on the renewable energy value curve, and people can get it all by purchasing a share in our publicly traded company. And what do they get for that? Our portfolio is we've invested about $83 million over our history, over 27 transactions with about 135 projects that we now have royalties on. And that covers the gamut, as you can see from the map. We are in storage, solar, wind, energy efficiency, biogas, and hydro, and we span the globe, generally speaking. We have a diversified and secured asset portfolio, and more than 80% of our portfolio is located in North America, and it's generating about 19% unlevered IRR since inception. We are intentionally disciplined and diversified, again, wanting to sample across multiple projects in multiple jurisdictions. We invest only in renewables, and we focus on proven technologies. I've had some experience on being on the bleeding edge of technology, and that's not something that our investors are exposed to. We only look at proven technologies, and we really, really like cash flow. So we don't really invest in long-term development cycles, which can be 7, 8, 9, 10 years. We're looking for investments that can return cash within the year because cash is what our investors want to see. Our target returns range between 12% and 20%. And I'll tell you a little bit more about why that is as we move along. And really the idea is that we are exposing our investors to both yield and to long-term growth. We really have two products. So how do we do this? One is a long-term royalty acquisition. So this is something that has a very high multiple of invested capital. We would essentially invest money for a 25-year strip of revenue off of that. The second product that we are involved in is a loan and royalty structure. So this is often the loan is a short-term bridge, 1 to 3 years. So we get a return of our capital, we get a return on our capital, and we get interest, or we get our royalty on that long-term project life. And we're right now about 50-50 in terms of that. Selected information, as of yesterday, our share price was about 42 cents with a market cap of $18.7 million. We have meaningful insider ownership at 24%, and we've got continual revenue growth year over year. Our company was named one of the fastest growing companies by the Globe and Mail Report on Business. Our business model has demonstrated strong portfolio performance and repeatability. As I said, we've deployed more than $83 million across 130 projects and have generated approximately a 19% weighted IRR, or a 1.5 multiple of invested capital. And we have an attractive spread. We generally borrow capital at about 6 to 9%, and we invest at returns exceeding 19. So that's a pretty decent structural margin. Our capital recycling model also allows us to continue scaling using recurring royalty revenue and continue to grow over time. In terms of the management team, roughly 100 years of experience. I think the key takeaway is this is the team. So we have the operating leverage that would say we could double revenue next year with the same SG&A. We don't have to increase our cost base $1 to double our revenue. In fact, we could triple our revenue, meaning all of that revenue falls to the bottom line. At one point in time, Wheaton Precious Metals, which is a large mining royalty, had the largest revenue per employee on the Toronto Stock Exchange. And that's the kind of leverage that we have with this royalty financing model. We have a board of directors that covers significant expertise across capital markets, renewable energy, and corporate governance. And their guidance supports our long-term strategy and disciplined approach to growth. So I want to leave you with two takeaways. I said at the beginning, I would like to explain to you that the renewable energy industry is a massive global market that is growing extremely rapidly. And secondly, we at RE Royalties are uniquely positioned to take advantage of this growth. And so I encourage you to reach out. Follow our progress on the TSX Venture, the OTC, the Frankfurt Exchange. I'd be happy to answer questions, and I'd be happy to have any of you reach out to me personally.
Peter, thank you so much. You have such a calm demeanor, and it's like it just makes everything more focused and more exciting to hear about. So thank you so much for all of that. We're going to jump into a little bit of Q&A. So as we know, renewable energy financing is becoming increasingly competitive as institutional capital flows into the sector. Now, Peter, from your perspective, where does RE Royalties still have an edge that larger pools of capital can't easily replicate?
I think it's in two places. So if you think of the traditional bank lending model, it's based on fees. So in order to generate fees and to cover their massive overhead infrastructure, they need to do large transactions. They don't get out of bed for anything less than 100 million, and most of them would look more like at the $1 billion range. Yeah. Where we think the niche is for small to mid-size is in that 10, 20, $30 million. And then there's the speed. Our record deployment was we addressed an opportunity on December 15th, and we funded by January 10th. So right over the Christmas holidays, that developer saved their project. They were at risk of losing their project, and we were able to step in and help them out. So that's the kind of speed that we can move at, and it's the kind of scale that makes it more attractive for us.
Now, behind the scenes, then, what are the characteristics or the signals actually you look for in cases like that for a renewable project that make you lean in more aggressively, we'll say, even before the broader market fully understands its future cash flow potential?
Yeah, so I mentioned to you that the market for electricity is very
Mhm.
different, but the infrastructure around developing and constructing, building, operating projects is very similar across all jurisdictions. So it's the same stool. It has the same four legs, whether that stool is in Europe or it's in North America or it's in Asia.
Right.
And so our team are all ex-developers. So we have the flat forehead that comes with trying to develop stuff. And we've all learned through the schools of hard knocks. So we're able to assess risk very quickly. We outsource things, local expertise like legal, because that's something that you can't really apply across jurisdictions.
Fair enough.
And we have a very elaborate investment committee approach that walks each investment opportunity through the same scale. You know, what's our security? What's our time to value? Because time to value is super important. The longer our money's invested, it's got to have return very quickly.
Fair enough.
And
Yep.
then do we trust the partners? And so this is one of the reasons we love platform clients, groups who are growing, because we do one transaction with them, then we do another and another. And so far, about 40% of our book is repeat clients.
That's amazing to hear. That's really good. Now, I know that RE Royalties recently announced a strategic review to evaluate pathways for long-term shareholder value creation, while also continuing to expand the portfolio with new solar and battery storage investments. So, behind closed doors, what do you believe the market still isn't fully appreciating about the underlying value of the platform you've built?
I think it's a function of as I say, 1% of the Toronto Stock Exchange right now is focused on renewables. You know,
Sure.
banks and oil and gas companies are the preponderance.
Right.
So there isn't that natural ecosystem of being able to present to small investors and retail investors our
Mhm.
ideas. So that's one challenge we have. And I think the second challenge we have is looking for permanent capital. So we've been very effective at raising green bonds, but they're on a 5-year tenor. So every
Right.
5 years, we have to renew, re-up, or repay those green bonds. Our
Mhm.
royalties have a term of 20, 25, some 40-year. And
Mhm.
so we really need to match that capital with the duration of our portfolios. And so that's part of the reason we're out for that strategic review, is looking for that permanent capital that can be part of our capital stack that
Yeah.
that matches the long-term nature of our investments.
Well, we have run out of time. I know that there's a million more questions that we could definitely bring up and ask about. But for right now, I think that gives us a really good insight into the company, into what you're doing and what to look out for. So thank you again for your time, Peter.
Thank you, Lindsay. We really appreciate it.
Absolutely. We'll talk to you soon.
All right. Bye-bye.